Has the bankruptcy boom arrived? Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee because I'd like to have a look at an article which is talking about a change in, well, companies going into administration. Spike in zombie companies going into administration fuels fear of an insolvency wave. Now, earlier, well, the end of last year, and I can't believe I'm saying that now, back in December, I made a video called 25 Days Until the Bankruptcy Boom, an update about the 2020 recession. And in the video, I discussed the fact that insolvency rates for, well, personal insolvencies, but also external administrations of businesses are about half of where they normally are. So I argued that once these trading while insolvent provisions disappeared, we'll start to see a boom in bankruptcies or insolvencies or external administrations. So what's happening here in this article? They're talking about this. So back in that video, here's some of the figures. So this is from the ASIC, the companies entering external administration. You can see here that in 2020 and September quarter of the 2021 financial year, it's just crashed. It has crashed. You can see the number of companies: 2 in NT, 79 in WA, a whole lot in New South Wales, 356, and 166 in Queensland. Tasmania had none. They were doing quite well. Here's the companies entering external administration compared to the average. So the only place, most of them were under 50%. The only one doing red hot was Canberra. So now, well, the data has come out. We've got updated data. And let's have a look at this. So here we have companies entering administration. This is the crash that we see down here. And this dashed line here, that is, well, that's the trend line. So you'd kind of think, you know, probably about 2,500 would be an average straight down the middle. So we've had an uptick. So the data is already, this is the December data, it's starting to tick up. And that's what I argued we're probably going to start to see, because remember, we're in a recession, everyone. We've had a recession. Times are tough. They're juicing the economy. And because of that, external administrations are below at half of where they normally should be, not even with a recession. So it doesn't make any sense. So the concern is that this is just the tail end. What's going to happen now? Because this is December data. What happens moving this month forward, everyone? I mean, have you heard of companies that are going under? Let us know. So we can see here in this previous chart where we had the numbers of companies entering in states were from 0 to 356. That was the scale there. Here we're going now from 7, so no state had none, to 772. And once again, it's New South Wales running hot. And here we have it from the average. Now, so Queensland, unsurprisingly, is at 115%. We're right up there. We're 115% of the average. The average, everyone. WA, 117%. They're the leaders. And there's another article I read with Western Australia, kind of like the world's best economy. There are 117% of companies entering external administration. Now, could this be a sign that the new changes they've made to allow companies that were on the brink to kind of trade their way back into business? Perhaps we could see. But so far, what we've heard, only a few companies have actually taken advantage of that. South Australia is at 99%. New South Wales is at 97%. Victoria is at 111%. NT is at 88%. And good old Tassie leading the way with the lowest number of external administrations at 48%. And the ACT, I have to bring up my Excel file because I can't see it there, but it'll be somewhere in the middle. You can tell by the color. So, I mean, there you go, everyone. Insolvencies or external administrations are starting to go up. Now, will some of those companies survive this external administration process and continue to trade? Hopefully they will. If you want to know, if you are a tradie, if you want to see external insolvency notices, type in ASIC insolvency notices, and you can see published notices here, and you can search, and there'll be, if you're a creditor, if you've worked for someone, they're going under, all the notices from the businesses that are administering them will be put up here. You can see them all. It's pretty sad to see. Hopefully you'll get some money back. That's the thing, you're an unsecured creditor. I'm terrified to hear stories about subbies. As an architect, I've been stiffed. I've had people not pay me. It happens. But my wage, my burden is wages, which right now it's just me and the missus. But, equipment, software, that type of stuff. The real people I feel sorry for are the ones that actually go out there and buy a product and attach it to buildings. They have to maybe borrow their own money to fund the construction of a project, and then they get stiffed. So we've had a look at the published notices here from ASIC. Now what I'd like to go through before we go looking at that article is another article from CreditorWatch discussing, more up to date even than the ASX figures we looked at. So does a sharp rise in administrations hint at tough times ahead? Now the ASX data, it comes out every quarter. Now this is a little, more up to date. A 61% increase in external administrations compared to January 2021 and a 50% decrease when compared to February 2020. So again, we're still going up. We've gone up since January. We're still below. We're still at that half of where we should be with regards to administrations. A 29% uptick in credit inquiries recorded on CreditorWatch month on month. Now this is you can contact CreditorWatch to get, find out about the credit rating of some of the businesses you want to give a line of credit to as a small business. Let me know if you've actually ever done it. I never have. I probably should have, to be honest, but I never got around to it. A 3% decrease in court actions month on month and a 56% decrease year on year, and a 6% drop in payment deferrals month on month. So there are signs that Australian businesses are adjusting to the new normal, with credit inquiries jumping and trading conditions improving after the height of the pandemic. Having been in decline for the previous 12 months, the number of external administrations have also soared by more than 50% in February compared to the previous month, hinting insolvencies are poised to return to historic levels. So are we going to hit back at those levels? This is a sign of the commercial climate returning to more normal conditions. From the CEO Patrick Coughlin of CreditorWatch. This figure is likely to rise again in coming months as JobKeeper ends and the 3-month reprieve on credit arrangements for struggling smaller businesses come to a close, he said. Last year, the federal government put in place a temporary moratorium on insolvent trading to allow businesses that were solvent prior to the pandemic to trade through it, giving them time to right their operations as the economy normalizes. While the provisions ended on the 31st of December, businesses with debts under $1 million were given an additional 3 months to work with an insolvency practitioner to restructure their operations and come to arrangements with creditors to allow them to continue trading. This, along with the job seeker wage subsidy, comes to an end on the 28th of March, so in 18 days from the time of recording. This could prompt a rash of insolvencies and subsequent redundancies, which could be a destabilizing force on the local economy. The number of arrears and court cases related to bad debts tend to rise before insolvency numbers lift, and whilst there is no evidence of this yet, an increase following the end of government incentives at the end of March is a strong possibility. So credit inquiries on the rise, so people are making more credit inquiries. So a monthly rise in credit inquiries indicates businesses are stocking up and buying the underlying materials required to make products and services to fuel economic growth. There are already signs economic growth is poised for a strong upward swing, given GDP for the December quarter grew by 3.1%, a significant turnaround from the 2020 mid-year recession. So here we have the payment data for key industries. According to February CreditorWatch Business Risk Review, only 4 out of 19 industry groups reported a decrease in the time it takes to pay their bills when compared to January. And we can see here, and I will just jump over to the right screen so we can see it here. Agricultural, forestry and fishing, it's gone up. Mining's gone up. Manufacturing's gone down. Electricity, gas, water and waste services have gone down. Construction up. Wholesale up. Retail, tiny bit up. Accommodation has gone down. Transport and postal warehousing has gone up. Everything is up. Everything is up. And these are the days. The number of days of payment is overdue by industry. Now, I think the longest we've had is like 90 days, 120 days. It's just crazy, everyone. That's construction. That's construction. So, we can see here. I mean, here's the sector. Monthly change, annual change. Wow. 200%. Mining, flat. Accommodation down. So, what's the outlook? Expect the rubber to really hit the road in trade payments in the March CreditorWatch Business Risk Review with the end of government stimulus. So they're watching for March. So if we jump back to this article here, let's have a look at this now. And I will delete this here, which I've already highlighted in the past. So the spike in zombie companies going into administration fuels further insolvency, fears of insolvency wave, like I was talking about. Everyone. There's worrying signs company collapses could leap back to historically high levels. Now, we're not talking about historically high levels. We're not worried about historically high levels. We're just worried about the average, just leaping back to the average, and it looks like it's heading that way. CreditorWatch's latest business risk review data released on Tuesday shows external administration spiked 61%. The federal government implementing a temporary moratorium on insolvent trading. Yes. There we go. Nothing else she's really discussing here. Administration and support services also suffered as offices remained empty. You know. And here's the real kicker. Meanwhile, the latest NAB Business Confidence Index shows promising signs of sentiment bounce back and easing of government restrictions. Sentiment is up, everyone. Could that just be the media fueling this? You're reading in the paper, housing's going crazy. You're talking to people, it's going crazy. You got friends in housing, it's construction, it's just booming. What do you reckon? So, do you think we will see an insolvency boom going up? Remember, we're still about 50% down from there according to the CreditorWatch data. There's a lot of room to move. It's definitely going to be interesting to see what happens, particularly when all the support mechanisms and interventions in the economy disappear. As always, thank you for watching. Please like, share, and subscribe to the channel. Let me know your thoughts and opinions in the comments down below. If you're a fan and enjoy the content I create here, there's a few ways you can support us. You can join the channel on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, have a great day. I will see you all next time. Bye for now.